Listening to a playback of Forethought Planning's Economic Update with our guests from BMO Global Asset Management, John Adams and Nate Stading. Thank you so much for tuning in.
I will have you get started. Whenever you're ready.
Thank you for having us on again, Shannon. We have always enjoyed talking to your clients and friends. It's been a great honor for us to work together the last bunch of years. It's hard to believe how long we have worked together now. As Shannon mentioned, my name is Nate Stading, and I'm a regional director for BMO Global Asset Management. I'm based in Milwaukee, but I am a University of Minnesota alum, so I'm a diehard Gopher fan. As Shannon mentioned the football season, I'm still a little hurt inside because this is probably the most excited I've been for a season in my entire life. And then it's gone like that.
And it's also not sitting in front of any of your Gopher gear.
Which I have a lot.
We had an agreement last time. No, I'm just kidding.
But I did put on a dress shirt for the first time in like 200 days. So that's kind of a nice alternate change, right? So I've been in the industry for about 20 years, working in numerous different ways, but I've been with BMO for about 15. I have the great pleasure of introducing John Adams, who is one of our senior portfolio strategists for our multi-asset team. At BMO, we have about 240 billion in assets under management, and we have offices in over 14 countries. And why that's important is John sits on a team that is a global team, and they help design a lot of our asset allocation and economic strategy across not only the US, but across the globe entirely. So John serves as our co-manager for our BMO target risk funds, as well as our BMO model portfolios that we offer. He has been in the industry for about 20 years, did his undergraduate studies at the University of Valparaiso, as well as his master's degree at University of Chicago Booth School of Management. He's a CFA, and in addition to being a very sharp individual, he has 2 young children and lives in suburban Chicago. And often we usually do this in person as we get to travel together quite a bit, which is a little bit more fun than sitting on the Zoom, but we're getting used to it. So without further ado, I'll turn the call over to John and go from there.
Great, thanks very much, Nate and Shannon.
We were just reminiscing about how much more fun it is in person, but we'll settle for Zoom. So.
I usually do an event with Shannon every August, maybe for about the last 3 years, and I have a good buddy up in Minneapolis. So I always enjoy coming up there. But yeah, we'll have to do this one virtually, and then hope to see you all in person sometime soon. But thanks for everyone for joining today. As Nate mentioned, I am part of a 30-person global multi-asset team. So I'll take you through a bit of our global team before running you through our market outlook and economic overview. And there's definitely no shortage of things to talk about right now with U.S. election coming up, the fiscal stimulus, CARES 2.0, the uncertainty around that, U.S.-China tensions, and really the uncertain path of the virus and potential for a vaccine. But before we get to all of those themes, I wanted to talk a little bit about the team. So I am based in Chicago. There are 6 of us in the US on our multi-asset team. There are 30 of us globally. So we actually just got off one of our monthly asset allocation calls with colleagues in London and in Toronto. So there are 11 individuals in Toronto, 13 in London, 6 of us in the US, interacting formally on a monthly basis, but informally really on a daily basis, talking on the phone, virtual meetings, on chat, really talking markets. And you can imagine how beneficial that is for our portfolios and for our end clients when you're talking about Brexit with people actually there on the ground going through Brexit for what seems like forever, but it's been about 2 years now, talking about the USMCA or NAFTA 2.0 with colleagues in Canada, or getting their input when you saw energy markets kind of acting very strangely in that March and April period and recovering pretty strongly since. And those of us in the US are able to the extent that we can, try to inform our colleagues what's going on with US politics. Everyone's always very interested in the US political situation, especially this particular election, but also advising on what the Fed's doing, what the government's doing, really from a fiscal stimulus perspective. So I will take you through, I think it's slide 2, kind of a few main themes that we're speaking to clients about currently. And it really all starts with the virus. And you've seen Fed Chair Powell reiterate over and over again the path of the economy, depends on the path of the virus. And it really is true. And we've taken a few steps back here, especially here in the Midwest, with respect to the virus over the last few weeks. Some of the Sun Belt states, the situation has plateaued and improved in some cases, but it's still a bit of a difficult situation here in the Midwest, and some of the progress that we've made in other areas has been offset. We have talked a lot as a team about the various vaccines by Moderna, by Oxford University, about the progress, AstraZeneca as well in testing. And we are a bit more bullish than what we think is priced into the market with respect to a vaccine. The phase 1 and phase 2 trials have gone pretty well. There don't appear to be any significant side effects at this point. So we are looking forward to those phase 3 trials. But this will be one factor that we monitor very closely in the coming months to see if we can get the virus a bit more under control here in the US. And that really impacts unemployment in particular, which we'll talk about in the coming slides here. Moving on to the economy, we think the economic recovery is likely to remain relatively choppy over the next few quarters. So you saw a very weak Q2. We're going to get a very strong, by all indications, Q3. But you have seen data coming in a bit better than expectations here in the US over the last few months. And payrolls on Friday was the latest evidence of that. You saw a very strong number with the unemployment rate falling sharply, although it's still elevated at above 10%. But you've seen stronger manufacturing data, stronger services data, and notably it's coming in better than analysts' estimates. So what we call economic surprises, data is coming in better than expectations. We will be very focused on things like payrolls in the coming months. We have seen some exceptional growth, but with the virus, with resurgence over the last few weeks, we think that employment market might level off to some extent, and there will be some structural impacts on the jobs market in areas like travel and leisure. But overall, much better than expected economic performance. That really feeds into the fiscal policy discussions that we're having right now. And that's kind of the third theme here on monetary and fiscal policy. You've seen some lawmakers on the Republican side basically make the case that we have seen a pickup in economic data. And because of that pickup, maybe we don't need additional stimulus. So it's likely you're going to get maybe something like 20 Republican senators voting against any kind of fiscal package. But we are hopeful, and it is our base case, that we will eventually get another fiscal stimulus package. But to broadly summarize where we've come from on a fiscal perspective, it's really hard to overstate the policy response that we've seen, not only from a fiscal side, but also from a monetary side. So in the spring, you saw the Fed basically implementing a new acronym, a new program almost every single day, as far as what they were willing to do to support lending, support the liquidity of markets, support the functioning of markets, especially on the credit side. So the Fed learned a lot from their playbook in the great financial crisis in 2008, 2009, and we're much more proactive, acting very quickly this time with respect to policies. And that really supported equities and also credit. They bought investment grade credit in the US for the first time, really supported that area. Spreads have compressed significantly in that US investment grade market, and it's really supported investor sentiment overall. By all indications, the Fed's going to keep short-term rates close to zero for a very long time. They're likely going to make an adjustment to their mandate, probably in either September or December. To talk a little bit more about average inflation targeting, which simply means that they're willing to let inflation overshoot on the high side if they possibly can, to partially make up for the undershoot that we've really seen for the better part of 10 years. But basically what you're hearing from the Fed, other central banks, is we're going to do whatever we can to possibly support markets and economies. And that's really kept us moderately risk on in our portfolios, and that's been really a main driver toward our overweight to equities and our bias toward US equities. From a fiscal side, we talked a little bit about CARES 2. We're looking at probably something like a $1.5 to $2 trillion bill eventually. You might recall Republicans, their opening offer was $1 trillion. Democrats were at $3.4 trillion. Democrats last week offered to kind of meet in the middle at something like $2 trillion. Republicans balked at that, and talks were off. We still think we'll eventually get a deal. There are some contentious issues, especially around the extension of unemployment insurance, also around liability protection, which is really a key issue for Senate Majority Leader Mitch McConnell, for businesses, for schools, for universities. So we are watching that very closely. It was a very confusing situation over the weekend. You saw President Trump issue 4 executive orders on the extension of those unemployment benefits, among other things. It's unclear whether he has legal authority to do that. He basically reallocated money from other emergency funding sources. So you might see Democrats continue to really push back on those elements. But one notable feature is that it relies on states to provide 1/4 of that $400 unemployment extension, which is difficult for states that are already in pretty dire financial straits and are hoping for additional aid from this CARES 2.0. But despite this contention around CARES 2.0, the fiscal stimulus globally has really been massive. And to put that in perspective, the response from a fiscal perspective globally has been about 9 trillion, and that's equal to about 12% of GDP. So you definitely can't make the argument that governments haven't been supportive here from a fiscal policy side. And then finally, talking a little bit about positioning, one notable takeaway that we've noted as a global investment team over the last few months is really this disconnect between economies and markets. And you've really seen markets kind of shrug off macro risks. If you want to point to the US election or US-China tensions or the path of the virus or an uneven global recovery from an economic standpoint, markets have continued to rally. And even when the talks broke down over the weekend with fiscal stimulus, markets have continued to really rally this week. So the big question is, will markets eventually begin to price in these risks, or will they continue to really shrug them off? And it seems that anecdotally, there are a lot of investors in the sidelines who kind of missed out on this rally that we've seen since the end of March and are really looking to get back in. So if we did see a sell-off, we'd likely be buyers in that scenario, but we think we'd have to be pretty quick to do that because there are a lot of investors in the sidelines kind of waiting to do the same thing. And additionally, we added 2 investment-grade corporates during the second quarter. I mentioned a little bit of the rationale for that was the Fed support, but that really put a backdrop behind investment-grade corporates. There are a lot of investors looking for yield, especially more conservative investors. We think that investment grade is a nice place to pick up a little bit extra yield. We don't expect a lot more spread compression, but it is kind of a nice coupon to clip in this environment with what we think is relatively limited downside risk. I'll touch on market returns for Q2 briefly on slide 3. Really a strong finish to Q2, which extended into July and has extended into August. We saw US equities post a return of over 20%, which was the best quarter in over 20 years. The S&P rallied 44% from its March 23rd lows and is now up over 50% since that time period. Notably, European equities outperformed their US peers modestly in the second quarter. We think that's a positive sign toward further gains for equities, that some of these unloved markets performed pretty well in Q2. If you look at credit, US investment grade and high yield posted their best returns since 2009. So some very solid returns there in credit. We saw the so-called fear gauge, the VIX move decidedly below 30 after spiking pretty strongly in March. Investor sentiment is one interesting area. I mentioned that there are investors in the sidelines. Despite the rally that we've seen, especially in equities, there are a lot of investors that remain relatively bearish. And so we think that really provides more room to run with respect to those asset classes. Sorry, I think Nate just informed me that I'm maybe off a slide or two. I apologize. I'll reference the title of the slide that I'm looking at. But I'll move to our scorecard slide. Sorry, Shannon, did you want to jump in?
I didn't send out a deck in advance, John, because we didn't have it approved. So maybe you can just give a little bit more insight into what you're showing, or share your screen if you want to.
Sure. Okay.
I know you're operating off of 2 technical devices because this is the
Yeah.
world we live in right now. So we're going with it. Normally we have it in
Oh, sure.
person,
Okay.
right? That we
Yes.
can do. So
Yes.
just a little different. We all learn from these things. It's great.
Yeah. Our company actually does not support Zoom, so I'm going off my phone. So unfortunately, I'm not able to share my screen, but I'll definitely give you a bit more background on the
Perfect.
slides going
Thank
forward.
you. Thank you.
Of course. Yeah, I'll move on to positioning. What we like to show is what we call our scorecard. It's a one-page summary of how we're positioned and why. And looking across the scorecard, we separate the asset classes into equities, fixed income, and alternatives. And if you were to see the scorecard, you would see that it's flashing green for equities, so positive for equities, with a bias toward US equities. I mentioned the policy support for equities, but we also came into the pandemic in a better relative situation here in the US. I think the US provides some nice downside protection as well. So remain comfortable being overweight equities with a bias toward US equities. Our investment policy, what we like to show clients is that we're looking at really 4 main factors. We're starting with valuation. We know that works, but it works with a very long time horizon. So there we're looking at things like price to earnings multiples, for example, in equities. But we're supplementing that valuation signal with more medium-term indicators that we call economy, policy, and behavior. So I mentioned the economic outlook earlier. We're looking at things like how's economic data coming in relative to expectations, how's growth relative to trend. For policy, we're looking at fiscal policy, monetary policy, more recently trade policy, and that's been very supportive for areas like the US. And then finally on behavior, that's a shorter term indicator for us. When I say short term, it's not like a day or a week, we're talking more 3 to 6 months for that metric. And there we're looking at things like investor sentiment, which I mentioned is still a little bit bearish. We're looking at positioning, momentum, flows, technicals, all of those kinds of criteria. So we're very transparent about how we're positioned and why. And right now, our main view is to be overweight equities and a bias toward US equities due to the policy backdrop. On fixed income, we do have that modest overweight toward US investment grade corporates and a modest underweight to core fixed income. And again, that's just the relative attractiveness of corporates versus government bonds, where yields continue to be very low, and US 10 years now right at about 0.6%. So not getting much, getting actually a negative real yield in core fixed income. If we move on to kind of the disparity of the virus, we talked about the US as one of kind of the epicenters of the virus, but also areas like Latin America, other emerging markets have been a bit concerning. So that's really one focal point for us. If you look at areas like Europe, the situation is quite a bit better. And so that does give us a bit of pause for areas like emerging markets to potentially move into a heavier position there. We want to make sure the virus is a little bit more under control. But I mentioned we have seen some positive vaccine developments. There are at least a couple that look very promising. The US has ordered at least 300 million doses of the Oxford vaccine and the Moderna vaccine, hundreds of millions of doses there as well. So we don't think we have any particular insight into the vaccine, but we are watching it very, very closely. It does appear that hopefully by spring of next year, we'll have a vaccine that'll be effective, be able to be used. It's an open question how many people, especially here in the US, actually are vaccinated. There is some skepticism around vaccines, but we are hopeful that we'll have a high enough proportion from the vaccine to really reach more of kind of a herd immunity type of situation. From a business activity standpoint, I mentioned that manufacturing and services data is coming in better than expected. We really saw kind of a V-shaped recovery in manufacturing and services from the spring until more recently. We expect that to kind of level off to some degree, but China was really the first country to experience this, and the US and Europe have kind of largely followed that path by China. Japan's been one notable exception. It's really lagged behind the other areas. We think that's partially due to Japan's trade dependency. And we have seen global trade peak a few years ago and actually decline more recently. But you may have heard of these surveys, the ISM, manufacturing and non-manufacturing. They ask purchasing managers, are conditions getting better, worse, or the same? And those indicate growth going forward, especially the new orders component, which is a good leading indicator historically for equities in general. So we are seeing some positive signs there from an economic standpoint. Additionally, we're looking at high frequency indicators. You might have seen some of these indicators looking at big data, mobility. Apple's got a measure of this, Google's got a measure of it. We're also looking at things like Open Table, the dining app, how many reservations are being booked, looking at that from a regional perspective. And if you look at that higher frequency data, again, that suggests the economy recovered pretty sharply over the last few months, and that activity is again kind of leveling off to some extent. But we will be watching that closely to the extent we think that there is some predictive power in that kind of higher frequency data. But if nothing else, it's very interesting data to see kind of where people are moving around, how they're moving around, and kind of how confident they are going out. And we've been of the view that it doesn't really matter that much anymore what governments tell people to do. It matters if people are actually comfortable going out. So governments may open economies, but if people still aren't going to restaurants, aren't going to bars, aren't going outside, then there isn't much use from the government guidance. So I think a lot depends on how things go here in the fall with things like school openings. I have 2 small children, as Nate mentioned, so been very focused on the status of schools here in the fall. We have a hybrid plan where I live, but I think a lot of parents are skeptical that that will actually be able to be fulfilled, that we might kind of go in fits and starts here throughout the year. And that's very important. We've seen estimates that that's equivalent to kind of 1 or 2% of GDP if parents need to stay at home, especially if both parents are working and you have the virtual learning. I'm sure some of you are dealing with that right now, and it's a very, very difficult thing to go through while still trying to do your day job. Maybe a few more slides before we take questions, but just kind of outlining the fiscal stimulus in the U.S. It's been over $3 trillion so far, and again, likely to get about maybe $1.5 trillion more potentially in stimulus. This $600 unemployment extension, unemployment boost is the most contentious issue right now. So President Trump's extended that $400 through December 6th. Again, we expect some uncertainty around that in the coming weeks as Democrats may try to challenge that. Hopefully both sides will come together, we'll eventually get a deal. But it is clear and both sides agree that we do need to extend the unemployment boost to some extent. They're just disagreeing about the amount, and some conservatives have raised arguments about whether it kind of skews incentives for workers to not return to work, although the evidence doesn't really suggest that yet. And there are a couple of influential studies, one from Yale, one from the University of Chicago, that really outlines the argument for why it hasn't led to workers staying at home. It's more a function of there aren't jobs to go back to right now. So we'll continue to watch those fiscal stimulus discussions, and again, the unemployment piece as well as the liability protection, I think, are really the 2 key issues to watch. Democrats want a lot more money for state and local governments, which Republicans are pushing back on. We think that ultimately they will compromise on that issue. In an election year, we think it's in both parties' best interest to come to an agreement here. It's difficult to think that we won't get one here before the end of August into September. We talked about central banks remaining supportive. I won't say too much in this. Basically, the bottom line is that all central banks are either at 0 interest rates or negative interest rates, or very, very close to 0. We've seen central banks do a lot of interesting things as far as asset purchases, buy a lot of assets they never thought they'd be buying. Bank of Japan, for example, buying REITs, buying ETFs. The Fed isn't quite there yet, but if we saw a downturn, I think you could see the Fed potentially looking to other areas, potentially looking into equities rather than just investment grade fixed income. But you are seeing a huge degree of monetary expansion. The Fed's going to continue its balance sheet expansion, which is larger than any previous program. of quantitative easing. We get a question a lot from clients, what does this mean for the deficit with all this stimulus going through? Isn't that inflationary in the long term? Aren't we going to have a debt problem at some point? The short answer is perhaps in the medium to long term. In the short term, no. Governments can just keep rolling over this debt at very low interest rates. If we saw a spike in interest rates, that would be a more difficult situation for governments, but we don't think inflation is going to be a problem anytime soon. This fiscal stimulus is really more of building a bridge to more normal times rather than building inflationary pressures. It's kind of filling that stopgap, and we think policymakers could shut off that stimulus if and when we get an economic recovery. On the credit side, I mentioned our preference toward investment grade corporates. The Fed's really just poured liquidity into markets there, and spreads are now not far from where they were pre-COVID. So we have a lot of interaction with our internal fixed income colleagues as well as our external fixed income managers, and they talked to us a lot in that March and April period about how abnormal credit markets were functioning. But the Fed stepped in very, very quickly. Bid-ask spreads narrowed sharply, liquidity improved meaningfully. So that was an issue for markets for a couple of weeks there, but has largely been resolved by the Fed. We do know that defaults are picking up, especially in high yield, especially in the energy complex. You are going to see defaults rise, but we think that where spreads are now around 5% or so, that you're being pretty adequately compensated for that default risk. I'll say a quick few words on U.S. earnings, and then I'm happy to take any questions that you have. We are getting toward the end of the earnings season here for the second quarter. It's been a pretty exceptional earnings season. We do have a significantly negative number as far as earnings overall, about minus 33% year over year, which sounds like a very, very bad number. But to put it in perspective, the expectation coming into June was about minus 45%. So you've actually seen a record earnings season as far as earnings per share surprises by companies relative to expectations. And you've seen technology in particular do very well. So we do expect corporate earnings to remain negative for the remainder of this year, but analysts project that you will see some top line growth and bottom line growth in 2021 with respect to earnings. So, and again, that's another support for equities. We talked about valuation concerns a couple of months ago with a lot of clients when price to earnings ratios were more like 25. Now they're around that 22 level. And we mentioned at that point that we begin to get concerned if we don't see some earnings surprises and earnings growth come through eventually. Now we are beginning to see that. So I will stop there, turn it back to Shannon, and happy to take any questions on any of those themes or anything else that's on your mind.
John, you know my question a lot of times is going to belly into a political question for you, as these are conversations that I have with a lot of my clients. Right. And I'm sure if anyone wants to ask questions, feel free. We would like you to unmute yourself and ask the question, but I'm going to start with this question. John, you guys just put a really great piece out. It's probably a month ago now, that Nate makes sure lands in my inbox on a regular basis, around the privacy data and regulations around that for tech companies and how that could potentially impact the markets, given that we are at kind of all-time highs within that tech situation. How do we know that that won't be another 1998 tech bubble, given everything that's happening right now? We're very much reliant on technology, and technology stocks have seen the impacts of all of us. I mean, we're all on Zoom right now. I'm doing a ton of Facebook lives. I watch Netflix at night with my husband as we are binge watching. Sure. He will be very embarrassed as the show that we are binge watching right now. It's a gymnastics show. Don't tell anybody I told you. But what do you see as those being the impacts down the road?
I thought you were going to say Tiger King. That was a very interesting topic on our global team. My global colleagues were very fascinated by Tiger King a couple of months ago. Yeah, I think that's a great question, Shannon. We actually had a series of what we call mini investment forums where about every couple of weeks or so, we have external speakers come in and talk to us about a longer term theme. And those are, we rotate chair from the US, London, and Toronto. And one of those sessions was on technology and the potential of regulation in the technology sector. I would say it's a really interesting issue because it's one where both sides of the aisle agree that we need to quote unquote do something. They might disagree as far as what that is. But I think it's probably most acute in a scenario where Joe Biden wins the presidency, Democrats sweep, take the Senate. You could see some more movement toward a minimum tax potentially globally on technology companies. You might see Biden being able to form alliances on a global basis. And so bringing in Europe and other areas. So we've talked a lot about the technology wars between the US and China, and there's a big battle. Are you going to use the US system now? Are you going to use China's? And Europe's really largely agreed to use the US system. So I think it's an open question. It could dent the rapid rise of technology stocks that we've seen over the last few years, but we also think the US is going to be somewhat reluctant to go after its national champion tech companies. They do employ a lot of people. They've made quite a bit of money spread around across the economy. So we think that there is some risk there, but I think the US is going to be very careful as far as what they do to potentially dent the profitability of those technology companies. A lot will depend on the economic outlook as well. If Biden's elected president, if he inherits a rapidly recovering economy, you might be more likely to see more technology regulation, and not only technology, pharmaceuticals, financials, energy also. That might be a more ripe opportunity for regulation. If the economy is still choppy, not very strong, unemployment's still pretty high, it's hard for me to really see too much action happening, I think, at that point. But yeah, I would say it's a bigger risk under a Democratic sweep scenario. But yeah, it is one of these issues where you do have some broad support on both sides of the aisle.
If anyone has any questions, feel free to unmute yourself. If you can't unmute yourself and you start talking, I will unmute you. And if nobody has any questions, I have another one because I always got questions. Anybody? You can raise your hand. Okay. So, John takes himself off the camera. He's like, "Oh no, Shannon's gonna ask more questions."
I was just plugging in my phone. I'm sorry.
No, it's okay. So I think that there is, we talk about all of the numbers and everything that's happening and all of the analytics behind everything. And then we have the feelings part of reality and how everybody is feeling right now. And so as an investor, where you're feeling a little uncertain, and by little, I mean a lot of uncertainty, right, about what's happening with COVID, what is happening with racial uprising, what is happening with politics in general, and a huge election that's coming. What are the things that we should be doing as investors and focusing on right now as we look forward into the future, even 3 to 6 months, right? Because I think there's just this level of uncertainty before the rest of 2020 is over and what will happen.
Sure. Yeah, I think you definitely raised some very valid macro risks. And yeah, being in Chicago, we've definitely seen a lot of the racial tensions kind of taking place here as well. But I would say that the short answer is just to remain calm. Try to keep your emotions out of your investments. I would say, as far as our advice for investors, we see investors make very poor decisions when they let emotions get the better part of them. If they panic sell, for example, when things look a bit scary. So yeah, I would advocate for taking a more medium to long-term time horizon. You might see some volatility here going into the election. We think that would be a buying opportunity if you saw equities sell off, say, 10% or more. And again, we think there are a lot of investors in the sidelines that are looking to get back in. So we think that would be a very sharp and quick correction if we were to see that. But yeah, I would say it's really focusing closely on those risks and understanding what the likely path is of those various issues. But we do think that things are going to be a bit volatile due to those issues, and they're very difficult to predict. So we think if you look through them and look toward better economic times maybe a year or so from now, the path over the next couple of quarters for the economy, for example, might not matter as much as where we eventually get to. If you think we're going to recover, it might not matter what Q3 GDP is, what Q4 growth is, as long as you think that we're going to recover. But as far as those individual issues, yeah, there are a lot of investments that you can make from an impact perspective. Obviously, a lot of charitable causes that you can support for those issues that are kind of near and dear to your heart. But for me, it's really staying calm as an investor, focusing on the fundamentals. And the fundamentals are that policy is really maximum supportive right now, and the earnings outlook's improving and the economy's improving. And we think that portends more gains for risk assets.
Yeah, and I think some individuals might even say, but how and why, right? I think that's a lot of people's questions right now. No matter how much you watch the news, what you're educating yourself on, it still feels like, well, I still am in my basement, or I'm still sitting at my kitchen table, or, you know, I'm blessed. I get to come to my office because I'm literally exposed to like maybe one other human. So I get a break from tiny children Monday, Tuesday, and Wednesday. But life doesn't seem normal. So how do we, you know, transition into that space? And I think that's why, you know, you and I have always talked about financial planning and how critical that is as a role in what we're doing. And sometimes it's like even literally taking that statement or envelope or email that comes with your statement, right? And saying, okay, that's what it looks like right now. But it might not look like that in 12 months. And this is why financial planning is so important. Can you give a little bit more insight as to why you feel that is, even as somebody who is managing portfolios, why do you encourage that financial planning structure?
Sure. Yeah, I think it's, you know, we always ask clients, you know, have your long-term goals changed? You know, if we see a drawdown like we saw earlier this year, like we saw in 2018, if clients are feeling nervous or skittish, it's really, have your long-term goals change? And if the answer is yes, maybe we can make a change. But if the answer is no, my long-term goals have remained the same, usually it's in the investor's best interest to stay fully invested, and again, not panic or make emotional decisions. But what we try to do in our portfolio is really focus on the medium to long term. We think we can add value over that kind of time horizon. We see a lot of our peers trying to make shorter term trades. They're, with people being at home, to your point, Shannon, there are a lot of people on Robinhood and a lot of other trading platforms kind of day trading. And some of them have done very well, but that's kind of a dangerous game if you're trading on kind of not much information and you're bored at home and kind of playing around with various stocks. We think that investors are much better off in a diversified portfolio that's invested for the longer term. But yeah, it's definitely tough for everybody. I have two. Did
you join my live yesterday on Forethought Planning? I was literally talking about the same topic.
I didn't. No, I didn't.
I talked about I talked about how we as individual investors, if you're doing it yourself, we brag about the good stuff, but we don't always talk about the bad stuff.
Right.
And if you made a positive investment and added to a portfolio in end of March or beginning of April, and you've just let it ride this whole time, you look really great, right?
Right.
It's kind of that mentality that we got used to for the 11-year bull run that we had, right? Everybody was like, oh, I did such a great job. But really, there are a lot of pieces to look at. And you mentioned a diversified portfolio. Can you talk a little bit more about what that might look like for an investor who maybe doesn't speak the same language as you and I, which is, nerdy financial language?
When we talk about diversification, it's really across asset classes. So asset classes, things like stocks, bonds, alternatives, cash. It's about having really your risk spread broadly across those areas. The reason you do that is because they don't move exactly together. In certain environments, stocks and bonds have a negative relationship where if stocks are selling off, bonds are actually rallying. We saw that in the second quarter in that difficult spring period. And a lot of investors are concerned about bond yields being low, but when things get really difficult in markets, bonds are still one of the only kind of hedges in town, one of the only safe havens in town to go to. And you saw a lot of the reason why we hold bonds in a diversified portfolio despite a relatively low yield, that you have that negative relationship at times with equities, but especially in downdrafts for equities, usually bonds hold up fairly well in that scenario. And on the other side, we also talk about diversification inside of those asset classes. So inside of your equities or your stocks, that you have an appropriate mix of US stocks and European stocks and emerging market stocks. And that's important because for the US, for example, there are a lot of, we talked about technology companies, so-called growth companies. You do have a heavy weighting there. In Europe, you have a heavier weighting toward banks, toward financials. In emerging markets, it's a lot more kind of consumer types of names, depending on which market you're talking about. So it's important to have that broad diversification also. So you're not just having all US tech stocks in your portfolio, for example. That would have worked extremely well over the last couple of months, but you're taking a lot of risk by doing that. And there's no guarantee that past performance will repeat itself in the future.
Yeah, and even being conscious of that, like if you're not buying individual stocks or you're buying mutual funds, right, on your own, and understanding the level of relationship you have within each of those mutual funds to make sure that there isn't an overlap. And
right.
I talked about it in aspect of, okay, so then you have all these things that you need to look at as an individual investor. When is the time when you don't do it yourself anymore? And when do you hand it over to somebody like you, John? When is a good place to start thinking about that?
I think it's become a lot more difficult for financial advisors or for end clients to kind of do it themselves from an investment perspective. There are tens of thousands of individual funds to choose from a regulatory and governance perspective. For financial advisors, there's a much higher hurdle now as far as due diligence and proving why an investment was selected for portfolios. So part of what we do on my team is what we call manager research. So we're actually analyzing the underlying managers in our portfolios, using internal funds and external funds, passive funds, a nice mix, drawing on 20 people globally who are doing nothing but manager research. And so we definitely think there's a value in our global team, a value to having the expertise from a manager selection perspective as well, and portfolio construction. We look a lot into portfolios, looking at things like factor risks. I mentioned the growth factor, making sure you don't have a lot of large cap growth managers that are all pretty tightly, the returns are pretty tightly related, so that your portfolio is much more exposed to a certain factor than you realize it is. So we think there is a need for expertise. Individual investors, you might be very fortunate and pick up a bunch of good funds, but it's a difficult thing to do, and especially combining them in a thoughtful manner and understanding what you actually hold in those managers. We do a lot of work we call a look-through process, where we're actually looking into the underlying fund. What does this manager actually hold? Maybe they're an international stock manager, but they hold a fair bit of emerging market stocks, which are a bit riskier over the long term. So understanding what you're actually getting in an individual investment.
Yeah, absolutely. And understanding the diversification, understanding what you're getting, so at the end of the day, you don't expose yourself more
right.
To some of the things that make us feel uncomfortable. So just like kind of circulating all of that back, right? Because it goes back. We can have this great portfolio performing over here, and then at the end of the day, when the market hits the fan, which it will do, because right, it goes like this and gradually up, but it's a roller coaster ride that kind of always goes up. And sometimes it just hits little bumps, and sometimes it hits big bumps, and we emotionally react in those situations. And so understanding how you're going to hold yourself accountable. Charlie, I noticed that you unmuted yourself. Do you have a question that you would like to ask?
Yeah, I do. So a lot of what has been talked about is so counterintuitive to me, in the sense that John seems relatively optimistic. When I've talked to you, Shannon, you're kind of the same thing. As a retired guy, I'm not really investing anymore. So when the market drops, I'm not dollar cost averaging anymore. And so I get more worried about it. but I've always been taught that the market hates uncertainty, and whenever I see our president come out and get on camera, my stomach drops, because you don't know what he's going to say or what he's going to do. And now this whole deal with I may not leave the White House if I'm not sure that the election was right. To me, that just screams market plunge, because it's so out of place. It's so weird. But I don't hear, I guess, you guys being that concerned about it. I kind of, what I hear is the sun will come tomorrow and things will get better and blah, blah, blah. But I mean, this kind of stuff really scares the average investor, I think.
Yeah, I think that's a very fair point. I think the market has become, has kind of shrugged off a lot of what the president says as far as tweets or in press conferences. A lot of plans have not come to fruition. A lot of threats haven't happened. So I think the market definitely discounts a lot of what the president says. But I think the fact that we've kind of climbed this wall of worry is kind of evidence of the president does have quite a bit of power, but the broad economy is driven by other factors, and you've seen Congress respond very broadly as far as adding additional stimulus. I definitely agree. I mean, before I go on any kind of client meeting or presentation, I always have to check Twitter and see if there's anything I need to be concerned about or prepared about from kind of a question that I wasn't prepared for. But yeah, again, I think the longer this term has gone out, I think the market kind of ignores a lot of what comes out on Twitter for the most part, and discounts it. But it is a concern if we come into the election and President Trump falls kind of further behind Biden in polls. There is a chance he could get a bit more desperate and increase U.S.-China trade tensions, for example, or potentially other policies, or try to implement more through executive order. There is a lot of uncertainty around the executive orders over the weekend, and President Trump's talked more about payroll tax, indexing capital gains to inflation. We think it's unlikely that those policies will actually get implemented. It's just kind of using the bully pulpit to focus on issues that are important to the president. But I agree with you. It is concerning. It's definitely a risk, and we always are aware of what the president is saying. But again, the markets are really looking through a lot of that, kind of betting that most of it's not going to really come to pass.
Hope so.
And if you want to add anything, Shannon.
Yeah, I think that goes back to some conversations I've had over the last 4 years, even shortly after Trump was elected as president. The markets did react to tweets at first, and we did see a lot of fluctuation in the market. And then we saw exactly what is happening with John. Charlie, you and I've had one-off conversations. Of course, some of the stuff that comes out of his mouth literally is incredibly fearful for me. But I always stand by the side that my job is to be that, look at the positive side of things and know that no matter where we are, that there will be something that comes out on the other end that is positive, right? And so that's my job. My job is to be the sunshine. I literally have a yellow wall. So like, if you need to see the sunshine, you just got to Zoom call me.
Yeah.
But I see what you mean. And I think, one piece that we didn't address directly was this aspect that I've gotten so used to for so many years adding to my portfolio. And now I'm getting to a point in my life where now I'm subtracting, right? Because now I'm drawing on it. That's why you saved. And that's why so many save for retirement. You bring up a very good topic that is somewhat psychological for us to transition from this space of saving into now spending. And John said this earlier, like, have any of your goals directly changed? And I think as individuals, we always have to look at that as a standpoint, right? Have my goals changed? And if they haven't, well, the psychological aspect of now I have to switch my brain, right? Which it takes time for us to be able to do that. And it isn't just going to happen overnight, or, sometimes it takes a couple of years of us getting used to things to be able to do that. And that is hard for individuals who have retired during this time period, because there is so much uncertainty about what is going to happen. And I think that that's why we as financial advisors also focus on, what are the opportunities that we have for multiple sources of income, so that you're not just reliant on one piece of income in retirement. And how do you look at it in that perspective? And again, going back to the financial plan, which I will talk about over and over again, about what that looks like in our personal situations. And are we still going to be okay no matter what levels of market volatility look like? The worst, that's why, looking at Monte Carlo simulations in financial planning is so important, because it looks at like the extremities, and we kind of feel like we're living in that extremity period, right? No matter where we are, we just feel like there's this tug and pull. And how does that affect your financial plan in the end? So,
well, I just look at savings. You and Debbie are the ones that look at spending my money.
You're not saying that because she's not here. Maybe we should Zoom record one of our meetings just for comic relief for everybody else sometimes. Does that answer your question, Charlie? I want to make sure that you feel like your question is answered.
Yeah, I mean, like you say, for the first time in my life, I always was, as long as I was buying, it was dollar cost averaging, and it didn't bother me. And all of a sudden, I'm not doing that, and then we get into this very unique time frame that we're in, and you just start to think about that stuff. Like you say, I look at my investments a lot, but if you occasionally take a peek and you were at X amount and you just lost $50,000, it bothers you.
Mm-hmm.
And think, how long is it going to take to get that money back, right?
Yeah. Well, those are definitely, situations too that I'm happy to revisit on a one-off basis. If that's something that you want to make sure that we do, we can have an offline conversation as well. Anyone else have any other questions? This is, and anybody that knows me like the psychology of everything, just like literally like is the piece that I drive home the most, right? If we would have continued with that same attitudes and mindset that we had in March, right? Where we had all kinds of conversations about, do I pull out of the market now? Is this an appropriate time? Do I stick with it? Like with a lot of folks, right? And people were messaging and asking about those situations. We would be in a hurting part because we wouldn't have made up for the rest. And to John's point earlier, when we start to talk about a well-diversified portfolio, the bonds are what protected us in the downswing, and the exposure to equities is what helped our portfolios go back again. And so that's why I think, looking at that perspective in terms of your risk tolerance, just making sure that you always have a diversified portfolio so that we can do that. But thank you, Jerry. Anyone else have any other questions that you want to ask of these two gentlemen while we've had their undivided attention? Otherwise, we can wrap it up. And you can stay tuned because there will be more opportunities, hopefully at some point in time in person again, but we have some stuff coming up in the fall that will be interesting amounts of education that you'll be able to receive no matter where you are.
The only comment I'd like to make is I think what's fun for me about these calls is everybody has their own visions for their everything, visions for wealth, visions for social change, visions for what happens next. And I think the key is with financial planning is you can incorporate all those visions into what you want your wealth to do for you, whether it be what your retirement looks like and feels like to what kind of difference you want to make in the world around us based on everything that's going on. And I think incorporating that into your plan is key to being successful because it helps us navigate times where it doesn't feel good or there's a lot of things going on. We don't know how necessarily to make changes or make decisions in our investment portfolios. But if we keep our eye on that vision, that long-term idea that we have, we'll get there. Because if we don't know where we want to get to, we won't ever get there. And I think that's one thing about working with Shannon or working with a financial plan in particular can really help you over the long term.
Yeah. Well, thank you, Nate. I will send you that bottle of wine for that great support. No, I'm just kidding. Just kidding. John, Nate, thank you as always. You know, we get a little bit informal as well, just because we've known each other for so many years. I would just encourage individuals who are attending this or listening in playback mode when we share this later, if there are questions that you have, yes, I actually do have access to John on a regular basis and know how to get a hold of him, and he's got some great resources as well as Nate. And these are things that, you know, despite being limited to technology also means that we have more accessibility to each other to be able to have these questions answered in a way that now we can see each other as well. More often if need be than just a road trip. So thank you all for joining us today. Thank you, John and Nate, for your words. And I hope that you all have a wonderful day. And as I kind of always say in my sign-offs, everybody is worthy of wealth. So make sure that you're planning for that. All right. Have a wonderful day, you guys.
Thank you.
Thank you.